All right. Well, good afternoon, everyone. My name is Zac Nelson, and along with my colleagues Ben, Bethany, Luke, and Lilia, I would like to welcome you to our research presentation on Apogee Enterprises, for which we are offering a buy recommendation with a target price of $44.33. Our research team has found Apogee to have strong financial fundamentals, a robust and growing backlog, and excellent management that has made good decisions during the pandemic. In this short presentation, we'll provide a flyover view of Apogee's businesses, the architectural glass framing and services industry, some key risks and ESG considerations, and a deeper look at Apogee's financial trends and outlook. Synthesizing these, we'll step through our valuation models that led us to recommend our buy rating.
So first, I'll provide a brief overview of the business operating segments of Apogee. At a high level, Apogee designs and develops value-added glass products, and they do so under 4 distinct operating segments. From largest to smallest in terms of contribution to company revenue is architectural framing systems, architectural glass, architectural services, and finally, large-scale optical coming in at 5% contribution towards revenues. The 3 architectural segments importantly span the gamut of the architectural value chain, and notably each go to market independently. Apogee currently operates primarily in North America, but they also maintain a small Asian and European presence.
Apogee operates in the architectural glass industry, which has a projected growth rate of 4.35%. Revenues for the industry total $61.28 billion. On the chart, Apogee is listed in comparison to the revenues of top competitors, bringing in revenue of $1.4 billion. The architectural glass industry is moderately competitive. There is a low threat to new entrants and high rivalry between existing firms. As technology develops, there is an increase in substitutes to glass, such as polycarbonate plastics. Companies must bid against each other for securing projects, which drives prices down. Although materials are available from many suppliers, contracts make it difficult to switch suppliers. Apogee has a moderately strong competitive position in this industry. The company has a large brand portfolio and experience in project management. Operations are primarily based in North America and dependent on the US and Canadian economies. With an increased economy, the need to house employees and the desire to renovate old buildings contribute to opportunities for Apogee to increase revenue.
The execution of Apogee's strategy to mitigate the risks is the underlying risk among all 4 of these categories. Company-specific risk involves Apogee's reaction to the backlog caused by COVID and the growth of telecommuting. The manufacturing industry also depends largely on economic conditions of North America, as Lilia mentioned. Apogee announced that continued project delays and soft market conditions will negatively impact revenue in their fiscal 4th quarter, so they may not have the ability to lower their debt as planned. Apogee's global presence implies tariff, exchange rate, and political risk as well.
The environmental, social, and governance efforts of Apogee need to be considered in our analysis. Apogee is committed to waste reduction and has implemented recycling processes in an attempt to eliminate the negative impacts on the environment. LEED certifications have been secured for some of the company's manufacturing centers. The products that Apogee produces are designed to be energy efficient for consumers. The company is also involved in philanthropic contributions of over $1 million. A code of conduct is in place to ensure that Apogee is accountable and operating according to ethical guidelines. Executives are compensated using a balance of short-term and long-term incentives in order to ensure present profitability that is sustainable into the future.
We'd now like to walk through a few key components to our analysis of Apogee's financials. Over the last decade, Apogee has maintained steady year-over-year sales growth. The first 2 pandemic quarters in mid-2020 brought sales decreases of 20% and 10% respectively, which is obviously not ideal on an absolute level, but must be considered in light of the macroeconomic environment. As Bethany mentioned, Apogee still possesses a strong backlog coming out of this pandemic, and this fact, combined with a strategic shift to high-margin segments, should power much of Apogee's recovery. In addition, we noted that amidst rising materials prices, as charted on the right, Apogee's margins have consistently trended upwards over the last decade, which speaks positively to management's operational decisions and bodes well for continued profitability.
Moving to liquidity and coverage, Apogee has experienced a calculated decline in liquidity measures over the past 8 years. This is consistent, however, with the industry trend, and Apogee's current ratio has maintained a healthy around 1.5 in 2020 and early 2021. The recent extension of long-term debt maturity to 2024 and a reduction on Apogee's company line of credit also helped to alleviate these liquidity concerns. Moving to coverage and leverage, Apogee has seen a significant 4-year decrease in times interest earned. However, debt to equity has leveled out around 40%, which is again in line with the industry, which we've analyzed and are happy to delve deeper into in the Q&A. Apogee has debt covenants as well in place that provide extra assurance of leverage and interest stability.
Since turning profitable in 2012, Apogee has experienced a notable increase in return on assets and return on equity over the next 6 years. Fiscal years 2018 and 2019 brought a regression in these metrics, but Apogee rebounded slightly in fiscal year 2020 and reported return thus far in the current fiscal year presents an optimistic outlook. Repayment of debt stands as the undoubted focus of Apogee's use of cash. However, as Ben mentioned, Apogee has decreased its leverage, which means cash flow should be freed up for other opportunities. Speaking of opportunities, Apogee's executives have expressed a desire to turn on the spigot of capital expenditures as we come out of the pandemic. And along with a mid-January announcement increasing quarterly dividends by 7%, we see Apogee's commitment to investment in its business and return for its shareholders.
Our valuation methodology consisted of 4 valuation models that together valued Apogee's share price at $44.33, delivering a 12.2% upside. Based on our analysis, we decided to weight the cash flow models by 65% and the earnings multiples by 35% due to a lack of comparable competitors in the industry, accompanied by the idea that Apogee's value should be based upon their ability to generate and effectively use cash flows that will ultimately lead to top-line growth. The chart on the right represents each model and the intrinsic value assigned to Apogee's share price.
We wanted to provide a brief summary of Apogee's mergers and acquisition activity. While the firm has engaged in quite a few acquisitions of strategically aligned companies over the last decade, a slight lull since 2018 has us optimistic about a commitment to organic growth that supports our growth rate estimate of 2.5%. The chart on the right shows a graphic representation and justification for the beta of 1.53 that we use in our valuation models. Recent volatility in the market has seen a relative increase in company betas across the board, so we took a more holistic approach than a simple 52-week beta to compute our own value based on price volatility.
For our discounted cash flow and free cash flow models, we concluded that each of these models have an intrinsic value that is displayed above the chart. The most relevant variables we used included a weighted average cost of capital of 7.7% and a growth rate of 2.5%. In our sensitivity analysis, you can see that the target upside is 13%. In our analysis, we use a price to earnings and EV to EBITDA multiple. In the last 3 years, Apogee has traded at a discount relative to its peer group, and we expect this gap to shrink slightly, increasing the multiples Apogee is trading at. Our multiples analysis concluded a target price of $43.70.
From our analysis, we expect Apogee to continue to generate sales growth through new and existing businesses. We expect strong cash flows that will ultimately be used for capital expenditures and capital return to shareholders. The current economic environment with low interest rates and large amounts of stimulus will foster demand and make capital accessible. We believe that management's actions to address the current economic environment will continue when it comes to addressing the ongoing concerns that the pandemic has had on the industry.
Again, our research team has found Apogee to have strong financial fundamentals, a robust and growing backlog, and excellent management that has made the right decisions during the pandemic. Quoting the former CEO Joe Pushis in Apogee's Q3 earnings call, Apogee is maintaining a very strong financial position that has long been a hallmark of the company. He concludes, and our research team concurs, that Apogee has the strength to navigate through the uncertain environment and are taking the right steps to position the company for long-term success. Thank you again for your attention, and at this time, we'd like to open it up for questions.
Hi, this is Jake Salt. That was a great presentation. Well done. I want to first ask maybe a bigger picture question. How has the COVID pandemic altered the structural growth drivers of the company? And what is your outlook for the business in a post-COVID environment?
Yeah, so all of Apogee's architectural businesses were deemed essential businesses and continued to operate throughout the pandemic. However, in several cities like New York, Boston, and San Francisco, construction sites were closed. So that impacted project delays and contributed to the backlog. And then also after COVID, with the growth of telecommuting and more working from home, Apogee is making a strategic shift to small and mid-sized buildings.
Just to follow on to what Bethany was mentioning, we definitely feel that the presence of the backlog, which represents merely project delays and not merely cancellations, also speaks to eventually being able to realize those revenues for the firm.
Great, thank you very much.
Hey, this is Kerry Robinson from Macquarie. That was a really good presentation. I'm curious, the recommendation of a buy to get to the $44 price target, 2.5% growth is interesting, but it's not stellar, I guess. And so I'm wondering, do they need to do an acquisition, or do they need to spend a significant amount of incremental CapEx to drive that growth rate higher? What's your sense? Because and then I have a follow-up just related to that. I'm wondering how they're going to have money to spend on CapEx if they're spending a lot of money repaying the debt from the prior acquisitions.
Yeah, I'd say that we're pretty confident in Apogee's ability to grow organically, just with Apogee starting to rotate into those smaller format buildings and their new renovation business that they have. We're pretty confident. We would like to see them return to their 50 to 60,000 or million that they spend in CapEx each year. I know at the analyst day, they're saying that they might end up spending a little bit under that in 2021. But going forward, I think that they're going to return to that 50, 60 million mark.
Could you maybe on the financial analysis side, help me understand why margins and return on assets, return on equity, they all peaked in 2017. Why was that? And it coincided with the M&A transaction maybe. And I'm curious why that deal was so strategic, if it was dilutive to margins. Why did they do it?
Yeah, so their mergers and acquisition activity in 2017 was the acquisition of EFCO. That was strategically aligned because it allowed them to increase their geographic distribution of their products and services. Management did mention that they were running into some synergies, not really paying off right away with the EFCO transaction. However, they have said that they've figured out those problems and should be able to then realize the opportunities from that added geographic area.
I would also like to add that the EFCO transaction added some diversity to their backlog. EFCO specialized in multifamily as well as educational buildings.
Apart from paying down debt, how would you advise management to deploy capital?
I think we would all agree that it would be great to see those capital expenditures go back up, just because that does represent, for a manufacturing company, really being able to position themselves well for what we hope to see as a surge in demand coming out of the pandemic, particularly for these small to mid scale projects that Apogee seems to be really trying to strategically position themselves for.
I'll agree and add to that. I think seeing some capital expenditures, especially in the area of renovations rather than new construction. I know a representative for Apogee noted that over 50% of building stock in the US was built before 1985, which was when lots of environmental progress was seen in types of glass. And so positioning themselves for growth in the renovation specifically.
Okay. And
To
I'm
add
going-
one more thing. Oh, go ahead.
Yes, no, please continue.
To add one more thing, historically, Apogee has paid out a dividend as well, and recently they announced a 7% increase. So I'd also like to see them pay out that capital to their shareholders as well as share buybacks.
I'm going to go ahead and ask my second unrelated question here. How is the company positioning itself to investors who are focused on ESG?
One thing that Apogee is specifically trying to do to increase its social and environmental impact is to make sure that their products that they are producing are designed to provide energy efficiency to their customers, and their shareholders will see this as a green initiative and invest in it as it is a high quality product that is also beneficial to the environment. And that is something that a lot of organizations want for their buildings now. They want to be able to install green and energy efficient products into their buildings. So this is something ESG wise that has contributed to the fact that people want to invest in them.
Thank you.
Could you walk me through how management's compensated? I don't know if you guys looked at the proxy at all, but I know I'm sure they all have a base salary and they get some stock options every year, but what metrics are they judged on to get those options? Like, how do they get their bonus every year? What are they paid on?
So executive compensation is a mix of short-term and long-term compensation, and it also has both fixed and performance-based compensation. It's about 46% average for short-term compensation, and the long-term performance-based compensation is on 2 years, and it's designed to ensure that there is profitability for the future, and this comes in the form of stock option and awards for achieving those performance-based goals, which, interesting fact, the CFO did not receive any performance-based compensation awards for 2020 because a couple of their performance objectives were not met.
I would just like to add too that their short-term incentive metrics are sales, EPS growth, while their long-term is return on invested capital.
Awesome. Thank you.
Hey, this is Jake again. So as analysts, we typically rely on a lot of sources to come up with our investment recommendations. Can you discuss some of the non-managed or non-Wall Street sources that you used in your analysis, and how was that helpful?
When we were doing our analysis.
Sorry, go ahead, Zac.
When we were looking at sort of qualitative sources to bring into our analysis to kind of bolster management's reports, all the financials that we were looking at, we really did try to take that qualitative look at the macroeconomic environment, particularly here in the Twin Cities, looking at the impact on small businesses, on home renovations and projects, just really trying to get a sense for where the demand is headed for potential services that Apogee would be able to provide.
Yeah, thank you, Zac, and thank you for the question. I was going to say that, yeah, we believe and we've learned that a valuation must have strong numbers, and we did work hard to search for those. But it also strings along a narrative, and so we did try to look through areas
50 seconds left,
such as suppliers and Apogee themselves, the industry that they'll be moving into. See if we can get in one more quick question.
Sorry, yeah, I'll ask one. This Carrie again. Catalyst, how are they going to hit their price target? What's going to make people want to buy the stock today?
Yeah, they are one of the only companies that have all of these different segments. Many companies specialize in one or two, but Apogee has many different business lines, and with their strategic plans of shifting to mid and small size buildings and their technologies, we think that they're a great investment.
Okay, that's the time. Thanks, team.
Thank you.
Thank you, judges.
Yes, thank you very much.
Yeah, great job. Thank you, everyone.
Good job.